Two guys, same money, same starting line, same year. One buys a rental property, the other buys gold. They both go to sleep that night thinking they just made the smartest move of their financial life. And they're both partially right, and both completely missing something that's going to cost them. Because one of them is about to lose money every single month for the first 2 years, and the other is about to discover what it actually means to hold an investment that cannot earn a single dollar on its own, no matter how long you hold it. I've been in finance for many years. I've watched people build real wealth, and I've watched people hold the right asset the completely wrong way. Today, we're running the actual math, not the brochure numbers, not the YouTube thumbnail numbers, the real numbers over 20 years. And by the end of this, you'll know exactly what each of these assets actually does, what it costs you, and which one wins, and why the answer depends almost entirely on something neither guy thought about at the start. Let's meet Ryan and David. Same age, same city, same $55,000 salary. Both have managed to save $50,000. Both walk into this decision with the same starting position. The only difference is what they do with that money. Ryan puts his $50,000 down as a 20% deposit on a $250,000 rental property, a solid 3-bedroom house in a decent neighborhood. He takes out a 30-year fixed mortgage at 7%. Monthly payment, about $1,330. He finds a tenant who pays $1,800 a month. On paper, that's $470 a month in his pocket before a single thing goes wrong. Ryan feels like a genius. David takes his $50,000 and buys gold. Physical bars, a gold ETF, doesn't matter. He puts all of it into the one asset that every financial headline calls the safe haven. No mortgage, no tenants, no phone calls at 2 a.m. about a broken pipe. David checks his account once a month and does absolutely nothing else. Same money, same starting line, completely different bets. For the first couple of years, David looks like the smart one. Gold is having a moment. Inflation fears, global instability, central banks buying at record levels. In a single year, gold jumps 25 to 30%. David's $50,000 is now worth $63,000, maybe more. He didn't do a single thing. He didn't fix a toilet, screen a tenant, or get a 10 p.m. call about a leaking roof. He just sat there and got richer. Ryan is living in a completely different reality. His first tenant trashes the kitchen and leaves after 8 months. It takes Ryan 6 weeks to find a replacement. 6 weeks of zero rent. But the mortgage doesn't stop. Neither do property taxes, insurance, or the $3,200 HVAC repair that shows up in month 4 like a punch in the face. When you add it all up in year 1, mortgage, taxes, insurance, maintenance, vacancy, Ryan's actual cash flow is negative. He didn't make $470 a month. He lost money every single month. David's phone hasn't buzzed once. His gold is up 30%. He genuinely starts feeling sorry for Ryan. But here's what nobody tells David. Gold produces nothing, zero income, no rent, no dividends, no interest, no yield of any kind. It just sits there, a shiny asset that never once sends you a check. The only way David makes money is if the price goes up. And if the price doesn't go up, he earns literally nothing, while inflation quietly eats his purchasing power from the inside out. And that's not a hypothetical. From 1980 to 2000, 20 full years, gold lost value in real terms. Not underperformed, lost value. If you bought gold at its peak in January 1980, you didn't break even until 2008. That's 28 years of holding an asset that gave you nothing back. David didn't buy in 1980, but he did buy near an all-time high. And historically, that is one of the most dangerous entry points for gold. There's also the tax problem most people skip over completely. The IRS classifies gold as a collectible, which means it gets hit with a maximum federal capital gains rate of 28%, compared to 15 to 20% on most other investments. So even when gold goes up, Uncle Sam takes a bigger cut than he would from almost any other asset class you could have chosen. And the long-term return on gold from 1971 to 2024, about 7.9% annually, Stocks averaged 10.7% over the same period. Real estate with leverage did better than both. Gold's recent run has been genuinely impressive, but impressive runs are exactly what make people forget the decades when gold did absolutely nothing. Now let's be completely honest about Ryan's side too, because that $470 a month was a fantasy from day one. Here's what Ryan's real monthly picture actually looks like. Mortgage, $1,330. Property taxes, roughly $250 a month. Insurance, around $100. Maintenance and repairs. The industry rule is 1 to 2% of the home's value per year, which on a $250,000 property works out to $200 to $400 a month when averaged. Vacancy. The national average is 6 to 8% of the year, meaning roughly 1 month of zero rent annually. And if Ryan hires a property manager, that's another 8 to 10% of collected rent, around $150 to $180 a month. Real total monthly costs, somewhere between $1,880 and $2,260, against $1,800 in rent. Ryan is either breaking even or actively losing money in the early years. And that's before a single surprise hits. And surprises always hit. New roof, $8,000 to $15,000. HVAC replacement, $5,000 to $10,000. A bad tenant who stops paying and takes 3 months to evict. And if Ryan self-manages to avoid the property management fee, he's trading his evenings, his weekends, and his mental health for the savings. When you divide his actual net profit by the hours he's putting in, he might be making less than minimum wage. Real estate is not a passive investment. It's a second job that a lot of people keep calling an asset. By year 3, something important starts to shift. Gold's initial surge cools off. This is historically completely normal. Gold tends to spike during fear and uncertainty, and then flatten or pull back once the panic fades. From 2012 to 2019, gold went essentially sideways for 7 years. 7 years of holding an asset that produced no income and showed no growth. David is now sitting on $63,000 that isn't growing and isn't earning anything. Inflation is chipping away at what that $63,000 actually buys every single year. Ryan, meanwhile, is grinding, but the numbers are slowly, quietly turning in his favor. Rent doesn't stay flat. It rises with inflation, roughly 3 to 4% a year. By year 5, Ryan's tenant is paying around $2,000 a month. By year 8, closer to $2,250. But his mortgage payment, still $1,330. Exactly what it was on day 1. That gap between rising rent and his fixed mortgage keeps widening, and more of each mortgage payment is now going toward principal rather than interest, which means Ryan's equity is building faster with every passing month. The property is appreciating too. At a conservative 3.5% annual rate, Ryan's $250,000 house is worth around $295,000 by year 5, and roughly $345,000 by year 10. Ryan still gets the calls. He still deals with repairs and tenant turnover. But the math is no longer underwater. He's cash flow positive. His net worth is climbing. And David is doing nothing, which was the whole plan. But nothing is exactly what he's getting back. Now let's zoom all the way out and run the real numbers. Ryan's property, appreciating at 3.5% per year for 20 years, is now worth approximately $490,000. His mortgage balance after 20 years of payments is down to about $128,000. That means Ryan has roughly $362,000 in equity on a property he bought with $50,000 down. On top of that, Ryan has been generating positive cash flow for the last 15 years. After subtracting every real cost, every repair, every vacancy, every tax bill, his cumulative net rental income over 20 years lands somewhere between $60,000 and $100,000. Total position, roughly $420,000 to $460,000 in combined equity and cash flow. Now, David, if gold follows its long-term average of around 8% annually, which is actually generous given that he bought near a peak, His $50,000 grows to about $233,000 after 20 years. No income along the way, no rental checks, just price appreciation. And after the 28% collectible tax on his gains, his after-tax position is closer to $182,000. Ryan, $420,000 to $460,000. David, around $182,000 after taxes. The reason the gap is that wide comes down to one word: leverage. Ryan used $50,000 to control a $250,000 asset. That's 5-to-1 leverage. Every dollar of appreciation works 5 times harder. David used $50,000 to control $50,000 in gold. No leverage, dollar for dollar. That's it. When the underlying asset grows, leverage is a rocket. Over 20 years, Ryan's rocket had enough time to reach orbit. But if I only showed you gold's weaknesses, I'd be doing what every real estate influencer does, and that's not honest. Gold isn't a bad investment. It's a bad strategy when you treat it the way David did, as your entire position. Used correctly, gold is one of the most powerful tools in a portfolio. In 2008, when the stock market crashed 37%, gold went up 25%. During the panic of early 2020, gold surged while nearly everything else fell apart. When inflation spiked hard in 2022 and 2023, gold outperformed most asset classes. That's what gold is designed to do. It's crisis armor. It's not supposed to be your whole plan. If David had put 10 to 15% of his portfolio into gold and invested the rest, stocks, real estate, bonds, he'd have gotten all the protection without giving up 20 years of compounding growth. That's the correct use of gold. Gold also wins on simplicity in a way that real estate genuinely cannot match. No tenants, no maintenance, no property taxes, no 2 a.m. calls. You buy it and you don't think about it again. For someone who has zero interest in being a landlord or an active investor, that simplicity has real value. And in countries with unstable currencies, weak property rights, or political chaos, gold isn't just an investment, it's survival. Portable, universally accepted, and independent of any government's ability to manage its finances responsibly. In those environments, holding gold isn't conservative, it's essential. And to complete the picture, real estate has real, serious costs that never show up in the headline numbers. It's completely illiquid. If Ryan needs $10,000 tomorrow, he can't sell a bedroom. He either takes on more debt or he sells the whole property, which takes months and costs a fortune in transaction fees. We're talking 5 to 6% in agent commissions, plus closing costs on a $490,000 sale. That's $25,000 to $35,000 gone before Ryan sees a single dollar. Concentration risk is also real. Ryan's entire position is one property, one neighborhood, one city. If the local economy takes a hit, if a major employer leaves, if a flood zone gets redrawn, his net worth takes the full impact with no cushion. And the time cost, thousands of hours over 20 years of managing, repairing, screening, worrying, never appears on any balance sheet. But it's real. And for a lot of people, when they actually account for it, the returns look a lot less impressive. Here's the truth that both Ryan and David missed. Neither of them was wrong about what they chose. They were both wrong about how much they chose. Ryan went all in on a single, illiquid asset that demands his time, his money, and his patience every single month. He got leverage, cash flow, and appreciation. But he paid for every dollar of it in a way that never showed up in his original math. David went all in on an asset that produces nothing. No income, no yield, no compounding. He got simplicity and crisis protection, but he gave up 20 years of earning potential to get it. The real trap isn't gold. It's not real estate either. The real trap is treating either one as your entire strategy, instead of understanding what role each actually plays. Gold is armor. Real estate is a machine. You don't wear a machine into battle, and you don't put armor to work in the field. Use them for what they are, and the math starts working for you instead of against you. If you want to see how stocks stack up against both of them, we already ran those numbers, and the answer genuinely isn't what most people expect. That video is right here. Subscribe so you don't miss what's coming next.